welcome to episode 55 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
And I'm Rachel John.
Let's dive in.
All right. So, Eric, we have had a lot of interest in our segments, particularly revolving around retiring, Roths, taxes, all the good stuff.
My favorite.
Yeah,
I am
really,
excited.
it really is your favorite.
Today is a good day.
So I wanted to delve in a little bit deeper, specifically in how Roths apply to the retiree community.
Got it.
So before we kind of dive in specifically, let's broadly talk about Roth and kind of discuss like when people are talking about Roth conversions,
Yep.
what does that even mean?
So typically a Roth conversion is when you take money that is in a like rollover IRA
Mhm.
or a tax deferred account. Let's just say a tax deferred account, because even if it's in a 401k, you can get it to a Roth. There
Mhm.
might be another step, but you can still do it. All right. So if you take a tax deferred account and you roll it or you convert it into a Roth account, right? So you're going to convert a tax deferred account to a tax free account. And when you do that, you generate a tax bill. So ordinary income tax to you in the current in the year that you do the conversion,
Mhm.
right, equal to the amount converted. So if I exercise a $30,000 Roth
Mhm.
conversion, like I take $30,000 from a traditional IRA, and then I just go to my Schwab or Fidelity or your discount broker, and I press move money,
Yeah.
and then I go and transfer it to a Roth IRA. They're going to ask me how much tax I want to withhold.
Yeah.
Okay, so logistics, that's what happens. You typically are going to want to say zero if you're working with us. You're going to make sure you've dotted all your I's and cross your T's here.
Yes.
But anyway, you're typically going to want to pay the taxes out of a taxable.
Well, I was going to say we can talk about
Yeah,
that too. So it does sound like though, if you're looking into doing Roth conversions, that it's a place where the Venn diagram for investments and taxes kind of overlap pretty squarely. So having somebody who understands your situation in both of those aspects feels like it would be a huge benefit.
sure.
Um, because like you said, if you like if I do a Roth conversion that's too big.
There are no longer any takebacks. You
Okay.
used to be able to recharacterize Roth conversions and Roth
Yeah.
contributions. You cannot anymore.
And so if you're not fully like very, very aware of your tax situation and where that's going to put you at the end of the year,
Exercise caution.
yeah, exactly. Because then you end up with the potentially unintended consequence of pushing you into tax brackets you have no business being in or don't want to
Right.
be in addition to some other potential like Irma fees, right?
Sure. Absolutely. Right. So we want to be very deliberate about this. And honestly, one of the reasons to use Roth conversions is as a tool to realize income more than we have. So we can't always just go out in a given year and earn an extra $40,000 of wages.
If only.
But if we have an extra 40, or if we have $40,000 in a tax deferred IRA, right? Maybe a rollover IRA from an old job or even an old 401k, then we can take that money, pay tax on it today, and then never have to pay tax again. And you might be saying to yourself, why in the world would we do this, Eric? That's
Mhm.
silly. You just told me to pay more taxes, right? Yes, yes, we did. I did, and we did, right?
With an asterisk.
Yes,
Pay more
correct.
taxes
Pay more taxes,
now.
correct, at a rate that you believe to be lower than it would be in the future.
Sure.
Okay, so we want to pay taxes at a lower rate.
Mm.
It just makes sense to do so, right?
Yeah.
Let's assume just that we have $100,000 of income that we have to realize at some point. Okay, so when you have
You're gonna have to
dollars in a
realize
tax deferred
all of your
account,
income at some point, right?
correct.
Like
So
the government's
either
gonna make you.
either you or
Right.
your heirs. These tax deferred accounts, they cannot go on forever.
Right.
Used to be a lot easier. They used to have stretch IRAs. But anyway, now there's 10-year distribution rules. So either
Yeah.
you or your heirs are going to pay tax on
Correct.
it. Okay. So we're not talking about charities for now. I understand if somebody wants
Yeah.
to write in and say,
There are
well, here's
caveats.
the thing. Like, no, okay, great. Like, yeah, we'll talk about that later. If you want to do QCDs and give it all to charity, great. Then yes, you don't need to do Roth conversions.
That'll
They're a
be
lot less
separate
valuable.
planning tool.
Correct.
Yeah.
But assume you want to maximize your personal wealth and the wealth of your estate.
Yeah.
Okay. Someone's going to pay the taxes. It's
Correct.
either you or your heirs. All right. And it's either today or tomorrow
Mhm.
or in the future. So what we're trying to do is we want to pay our taxes at the lowest rate possible. So we're going to assume that we have $100,000 of income that Uncle Sam's making us realize.
Yep.
Okay. It's in our account. We have to realize that income. So we can either do it today when we're in the 22% marginal bracket,
Mhm,
or we can do it down the line when we believe ourselves to be in the 32% marginal bracket.
mhm.
So if we take all of the $100,000 in the 22% bracket, we pay $22,000, right? We can all
Simple.
do that math pretty easy.
Like it.
Okay. If we were to defer all of it
Yeah.
and realize that income when we're in the 32% bracket, we pay 32%, or 32%,
32,000.
$32,000,
Yes.
which is $10,000 of savings
Yeah.
if we would have just paid the tax earlier, right?
Exactly. And I think that's what's so challenging because we, as humans, as society, I think there's a mental block behind um, delayed gratification. And we've talked about this a lot. And I think that
Absolutely.
it's a lot harder to stomach doing something uncomfortable now. We're more comfortable kind of kicking the can down the line.
Right.
The reality, though, is that the government is never going to just be like we're not going to charge taxes this year.
Right.
So it's coming inevitably one way or another.
So let's talk about for a married
Yeah,
retired or retiring couple, right? So let's talk about the times when it would be might be beneficial for them, okay, to engage in Roth conversions
sure.
or a what's called a Roth conversion ladder, which really just means a series of Roth conversions.
Yeah.
Okay, it's just a term that people use to mean, hey, we know our income from ages, let's say 60 to maybe we're gonna start electing to take Social Security at 70. Now we have 10 years, okay, that we can start real that our income's gonna be artificially low because right when we start taking Social Security, it's higher, or maybe we have Social Security and a pension, right, at
Yes.
70. And then we have RMDs kicking in at 73. Okay.
Yeah.
So we know that our income is about to kick us into higher brackets. So we
Correct.
know, right, between 60 and 70 and then 60 and 73, that we have some years where we can convert funds at lower rates,
Yeah.
lower effective rates, okay, to Roths. All right. So those are the kinds of times. So when would we do this, right?
Yep.
When would we think this is a good idea? Well, we just said one of them, right? You're retired, you
Correct.
stop working, you have no wage income. All right. So you're living on your taxable accounts, like you're just withdrawing money from your savings or your brokerage accounts,
Hmm.
and then you're living on that. So your taxable income is going to be lower than it might be in the future, like we just described. Okay.
Correct.
So you typically want to do that. So retirement, like you've stopped working, but before Social Security and pensions kick in.
Yep.
All right. Another one that's pretty key is the year that your spouse dies.
Yes.
That's a big deal.
It
Why?
is.
Why do we care? Well,
Oh, I
because
can answer this one.
oh yeah, you want to go for it.
No, no, no.
So
It's whose happy place.
I do enjoy Roth conversions. They
Yeah.
are they are my jam. So you're going to be in when you're with your spouse in the year that your spouse dies, you're still filing as married filing jointly.
Oh,
Immediately after that happens, I used to think qualified surviving spouse sounds like it applies to everyone whose spouse died the prior year, right?
mhm.
Wrong. No, qualified surviving spouse is 2 years after your spouse dies if you have a dependent.
Dependent.
Okay.
Yes.
Typically, when your spouse dies and you're both very old,
Older.
you don't really have any kids living at home anymore,
Yeah.
right? So you're not going to have any dependents. You're not going to have any qualifying dependents there. So
Typically.
typically,
Right.
on average. So what does that mean? That means you're down into the single tax bracket, which means your marginal rate and your effective rate are going to be higher.
Yep.
Your marginal and effective tax rates are now higher. And remember, we said that our whole goal is to pay taxes when we are in the lowest well, effective tax rates. So
Yeah.
let's want to talk a little bit about that, you think,
Sure.
or
Let's do.
let's finish the list. Let's finish the list.
Okay.
Right. So we said we retired before Social Security and pensions.
Correct.
Okay. We said we want to also probably consider conversion in the year that our spouse might die because we're still married filing jointly.
Correct. Because you get that year still to be able to file.
Right.
So, like, if we're married and you pass away January 1st,
Mhm.
I still get to file married filing jointly for that tax year
Correct.
because you were alive for one day of the tax year.
Correct.
If you died December 31st, same thing.
Correct.
Um, and so there's a lot of planning that circulates around the shift from married filing jointly to
Absolutely.
filing single.
Absolutely
So
correct.
Roth conversions is a huge opportunity that you cannot go
Right.
back and take
Because
back.
what might happen is you might be in the 24% bracket,
Hmm.
right, with your spouse filing, married filing jointly. Okay.
Right.
Let's just look at the brackets real quick, right? So if we're married, okay, and we're in the 24% bracket, let's assume that we make, let's say, $300,000 of income. In the next year, if we make $300,000 of income, we're kicked into the 35% tax bracket.
Yeah, that's a huge
Does that make sense?
increase.
And
What,
typically
11%?
when we're retired, right, our RMDs aren't going to stop. our Social Security payments. Our Social Security payments will usually be cut in half, but you take the higher of the two.
Exactly.
Okay, so like there are some amount of deterioration in income. There's some amount of
Sure.
reduction in income, but it's usually not.
It's not at the rate
It's
of
not going to be half.
the increase of
Exactly,
exactly.
it's not going to be half like it would be in the tax brackets, right? So
Correct.
almost never. Right. So anyway, so the year of the deceased, uh, the year of the death of your spouse,
Correct.
right? But also, you have to think about the fact that we want to be sure that we're setting our spouses up for this, right? So we want to make sure that we wouldn't create kind of a tax torpedo upon our death,
Yeah.
because there's only so much you can convert, even in the
And
married filing jointly year. You still don't want to convert $1 million. You would still
you
blow
have to
yourself
have,
up.
yeah, you're still going to have
You're
that
still blowing
tax
yourself
bill.
up, right? So if we think that's a possibility or distinct possibility, it's another advocacy for, Roth
Correct.
conversions along the line, ladders along the way.
For example, if in our scenario you were to become sick, or we know that in the next few years things
Yes,
aren't looking great,
right.
then we want to start making moves to at
Yeah, you
least
want to
get
consider
ourselves up
setting
financially.
you up so that you're not left with a tax burden on top of the emotional
Do you
burden of losing a
like that I
spouse.
made you the one that died?
I don't like that. Well, yeah, I do. That's okay. You should be my place.
But statistically, that's
You
what's
should
right.
stand alone. Not me. I just
Sad. It is hard though, and I think that we're joking about it, but I do think that it's
we're terrible people.
no,
I'm
I
kidding.
think we've
Uh,
held the hands of clients through this exact process, and I
mm.
think that it's it's so important to have somebody who's able to look at the situation as objectively as possible, because
It's
chances
a
are,
rough time.
yeah, in the
It's
year
a
that you've
very rough time.
lost your partner, you're probably not
The
thinking,
last
how
thing you
can I
give,
min max
yeah,
my
the last thing you
contribution?
care about right
Yeah,
now is taxes,
correct.
usually for most rational
Correct.
actors and
But this
humans.
is also a year that's the most impactful, that can have the most benefits, but it can also have some of the most detrimental effects if things are
Right.
done incorrectly. So having somebody who's trustworthy, who you have a relationship with, who can kind of guide you
Yeah.
through that process is super important.
Make sure you think through it before you're there, right?
Correct. That's a big part of the whole planning process. Okay, so we have the retirement, death of a spouse. What else?
Preparing for that. There are also some considerations around heirs, as in
Well, I think,
if you take a year off work, basically
yeah,
at any point in time that you think your current income
correct, is
is
lower.
lower than it will be, than you reasonably
Yeah,
expect it to be in the future. Yes,
correct.
we know that we're not going to be exactly correct with everything.
But I
We
mean,
might think you will work till 62, but you only work till 61.
sure.
Haha, got you, right? Like,
And something that comes to mind is people who own their own business, or people who have
sure.
waves of income. If you start realizing, like, okay, this is a low income year, or I don't know, a hurricane came and so my business was interrupted for
Right,
X
right,
amount
right.
of months, whatever.
Those are good years. Yeah, yeah.
Exactly. So anything
You
where,
just want to explore the opportunities in those years, right? Try to make the
correct.
best of situations that aren't always great.
Correct. So we have talked a bit about, like, okay, um, like I'm ready to look at a Roth. You alluded to the fact that if you were to do all of your Roth conversion in 1 year, you're realizing a massive tax bill that
Right.
is just going to inherently propel you up into the brackets that we're trying to avoid.
Correct.
And so that leads us into something called a Roth conversion ladder. So,
Right.
what is it? When and how is it useful?
Yeah, it just means we're gonna target an effective tax rate. And let me just all right, we're gonna explain effective tax rates now. We have to. I feel
Yes.
like we have to, because
Okay.
people are like, you're talking about marginal brackets and effective rates. Like, why?
Sure.
Why the difference?
I
Okay.
agree. I agree.
So let's talk about marginal tax rate. Your marginal tax rate is the tax that you would pay on an extra $1 of ordinary income.
The marginal
Okay. So the
tax
tax
rate
on your next dollar.
too is the tax rate most people are familiar with. It's what's on your
Yes.
tax return when they tell you
Yes.
you're in the,
Ooh, you want to explain marginal versus just flat? Because that's look, it's no shame in it. A lot of people have a misunderstanding about how the United States
they do.
taxation works.
They do. I actually used to
Let's
do
talk
this
about it.
project with my sixth graders
That's
in math
awesome.
class. Um,
Well, now that you've just told people that don't understand that they're sixth graders, that's
no, I
okay. Okay,
no.
sorry.
It's a really complex concept, and I think it's one that is so challenging because we're given one number. You're in the 22% tax bracket. You're in the 24% tax bracket.
Right.
And so it's really easy to assume, okay, every dollar I'm making, I'm losing 24 cents on every
Right.
single
Right.
dollar.
That's terrible.
Yes,
That
it's
doesn't seem
terrible.
fair.
No, it's terrible. Um, and it's very important to know that the tax bracket that you're in is your marginal tax rate, which means that every additional dollar is going to be charged at that rate.
Okay.
And some dollars prior to that have very likely also been charged at the 24% tax bracket.
Okay.
But prior to the 24% tax
Yeah,
bracket,
what do I have to do?
there's also a 12% tax bracket.
Oh, that's
I
low. I
know
like that.
it is low. There's a 22.
Okay.
There are also
Better than
higher tax
24.
brackets than the 24.
Yeah.
And so the first, what is it, 10, 11?
11.6 for single.
Yeah. So let's say,
23.2 for married filing
okay,
jointly.
so we've been talking
That's
married
10%.
filing jointly.
Yeah, married filing jointly, first 23K,
Yeah,
10%.
exactly. So whether I'm making $300,000 or whether I'm making $50,000, the
The
first
first 23,
23,
still 10%.
correct.
10% for the what did we say, $1 million or
Exactly.
right?
Exactly. If
Yeah.
we're doing
They're
our
still gonna jump through the same bracket. They still have to fill up the smaller
correct,
buckets before they get to the bigger bucket.
correct,
Okay.
correct. And I think that that visual is really, really helpful. And that's actually something that helps make the point a bit more salient. You start with a
Think of like a
like
little champagne tower or something. It's a
yeah,
gallon of water
exactly.
pour in.
Well, so like if you have a small bucket, right? Like you got like your 10%, you've got your 12, you've got your 22. Those buckets start to grow in size. But not all of us have the same amount of income to put into said buckets. So like I might be showing up with, a 2 cup measuring cup,
Sure.
and someone else might be showing up with like a pool,
Yeah,
right?
yeah. Right.
What
Two
we
gallons.
have to fill up those buckets is very different, but we're all starting in the exact same place. We're all
Right.
filling up that 10% bracket before our 12,
Right.
And so I think that
So yeah, just wanted to make that point, right?
no, I
Is
think that's
our
really
system
good.
is marginal, right?
It
So when we're
is.
talking about marginal, we're talking about the last dollar. That does not mean all dollars. So if
Correct.
I make $100,000, does and I'm in the what are we talking here? Married filing jointly? Well, we said married filing jointly. So that would be in the 22%
22.
bracket.
Yeah,
But it's notable that that would not mean all of I would not pay $22,000 in tax.
correct.
Okay. I would actually pay very little in tax. Okay. I would pay a lot closer to 10,
Correct.
under 10.
Correct. So it
Well under
isn't,
10.
yes. And so, we can certainly calculate now with software number, like all of the information we have,
Right.
exactly what you would pay in tax.
Right. But so okay, so we talked about marginal,
Yes.
right?
But
When
we are talking a
we're
lot about
talking about
effective.
effective, what
I
is the
know.
difference? Why are we talking about why do they keep saying effective? Okay, so I want to be very clear. Effective, when we talk about effective, we are considering like EFP, equal like our podcast, right? For
Yes.
now,
Yes.
accessible finance is considering effective tax rate to
Yep.
be your total tax liability
Yep.
plus credits you've lost or
Hmm.
may no longer be eligible for,
Yep.
plus um, penalties you might have to pay.
Yeah.
Does that make sense?
So exactly. I think it
Divided
helps.
by your taxable income.
Sure. And so what it really does, the
What does that
effective
mean?
tax rate, I think helps to capture a lot of the missed opportunities and factors in those various buckets from start to finish to really give a good big picture view of
Right.
like what are we actually paying? How
So,
can I compare this year
so
to next?
let's try to contextualize this just a little bit,
Yeah.
right? So, if we're talking about maybe filling the 22% bracket,
Hmm.
all right? Let's say we want to fill the 22% bracket for a married couple.
Okay.
We want to look at what doing so does for the like what impact that has on
Correct.
their total tax picture, not just their marginal tax bracket.
Yeah.
Okay, maybe we assume that they're going to be in the 24% tax bracket tomorrow. Okay, so we want to fill up the 22. But then we go and look at it and we say, hey, wait, if we fill up the 22, then that will kick them into a higher IRMA bracket,
Hmm.
right? Like they'll have to pay more in Medicare premiums because let's assume they're over 65, right? And there's a 2-year look back, and we've talked about IRMA before, but basically, we want to be mindful of all of the implications that our
Hmm.
conversion will have
Yeah.
because conversions will increase our what's called AGI
Yeah.
and then modified AGI or MAGI, right? Like so modified adjusted gross income and adjusted gross
Hmm.
income. So it's going to do both. It's going to make it higher. And
Yes.
sometimes, so what are the things when you say effective, what exactly are you guys considering? Or what are the most, let's say, what are the most impactful that you're considering,
Yeah.
right? Because some of these things probably aren't going to matter to the people that we're working with. Let's be honest, like earned income tax credit, yes, probably disqualifying you from that, but you probably weren't getting that anyway.
Correct.
You know what I mean? Like if you're talking,
A
wealth
financial.
planners,
Yeah.
like financial planners, you probably have more than
Correct.
or qualify for that anyway. But basically, so what exactly are we talking about? So we're talking about basically the difference in the marginal rates plus things like IRMA, right? IRMA brackets. What are these? What if impact does this have on IRMA? And the
Correct.
way we think about that is the increase in monthly premium
Hmm.
times 12
Correct.
because it's
So we're
geared.
looking annually, exactly.
Exactly. Right.
And I think it's important to touch on the fact that quickly that IRMA brackets don't fall, like they
On
don't
tax
coincide
brackets.
with
Yeah,
tax
that's a
brackets.
very good point.
So it's not like I can fill up my 22 and be safe.
Exactly
There are
correct.
different
No,
like
you're that's
stopping
a
points.
very good point.
Thank you.
Very good point.
Thank you.
Well done.
Thank you.
Boy,
Thank you. Thank you.
you guys are lucky. She's
Um,
great.
but it is important, and I think that that's why when we talk about effective tax rate, it's so impactful because not all points in the 22% tax bracket are created equally.
That's exactly right. And the
Yep.
IRMA thresholds are what they call cliffs, which mean if it means if I go $1 over it, then I'm paying the whole IRMA extra premium. And they're usually in about $80
Yeah.
increments,
They're
okay?
not
80 to
scaled or
$100,
anything.
okay? Does that make
Exactly.
sense? So like it would be like let's say it's $100 increments, right? I'm paying an extra $1,200 if I go $1 over. Remember, because
Correct.
it's like, $100, 12 months, right?
Exactly. And so we would factor that into your effective tax
Right. So
rate
you look at that when you're
because you're
evaluating conversions. So
because you're paying $12,000
yeah, then we
more
weren't
than
going to pay
you
otherwise. If I
exactly.
don't do the conversion, I don't pay this twelve hundred
Correct.
dollars. And if I do the conversion, I do pay this $1,200.
Correct.
I need to consider that.
And I need to make sure my benefit outweighs my
Exactly.
risk.
So we said effective tax rate. We're considering IRMA.
Yep.
We're considering net investment income tax.
Okay.
Okay, which is just taxation on investment income when you're over thresholds. Okay, it's like 200,000 for individuals, 250,000 for married, filing jointly. This
But again,
this matters.
not coinciding with our
Not
tax bracket
not
cutoffs
cleanly going to coincide with brackets. Absolutely not.
or the IRMA cutoffs.
Correct. They're not none of these right. None of these line up cleanly.
Yeah,
Software does a really good job of this.
it
Actually, it
does.
shows you nice clean grass. It's pretty cool.
It
But
does.
basically, you need to be mindful of all this stuff,
Yep.
right? And then what's another one that's very important to retirees, particularly before they engage with Medicare,
Mhm.
is the premium tax credit. Okay, or also known as like Obamacare
Yeah.
subsidies.
Yeah.
Okay, so when I go get insurance, when I separate from service and I'm no longer on my employer's healthcare plan,
Correct.
or maybe and I just don't maybe I don't want to be, and maybe I don't even want to elect Cobra because that plan was bad, right?
Hmm.
Or I can get something else, or maybe I'm just out of the Cobra limits, right?
Yeah.
So I've been separated from service for a while, but I'm not 65, so I can't jump on Medicare, right? I don't qualify for Medicaid. What do? I go to the marketplace, I have to get insurance, but if I have a low enough income,
Yep.
then the government will subsidize it with what's known colloquially as Obamacare,
Yep.
right? So we would be potentially disqualifying you from that. And if we did, we want to quantify that. Like, what does that mean? Okay, well,
Correct.
I was going to get $4,000, let's say, of premium subsidies, like rebates
Correct.
and credits. So now I have to consider that as an addition. We consider
It's
that
a
as like an
cost.
additional tax,
Yeah, it's an
right? So if
additional.
we're going to assume our tax liability is $15,000, we're losing $4,000 of premiums. Let's just consider it
19.
$19,000 because
Correct.
that's now what we're going to owe, right? So
Exactly.
that's what we mean when we say the effective tax rate. We're minimizing effective tax rate,
Correct.
which can be thought of as marginal tax rate with considerations
Mhm.
for IRMA, net investment income tax, premium tax credit.
Exactly.
Among the other ones, right? Like there are other things that we would consider, particularly for younger clients, like the child tax credit matters, like
Hmm.
American Opportunity Tax Credit,
Yeah.
lifetime learning credit. There are a lot of credits, a lot of deductions that you can't take once you go above certain thresholds.
Correct.
We're considering that. Those in aggregate are what we're considering, what we're referring to as effective tax rates.
Knowledge and a true understanding of this is what ends up netting more dollars in your pocket rather than paid to the government.
That's exactly right. That is the goal. That's what we're trying to do here. So,
Always.
to be clear, we are trying to minimize your effective tax rate over your lifetime. And what that tends to look like is we want it to be flat.
Yes.
Does that make sense? We do not want to be paying, 37% today and then 12% tomorrow, right? And we don't because we want to be filling up those 12% brackets. We want to fill up probably the 22% brackets. We want to fill up what are considered the lower brackets
Correct.
for you. That's relatively speaking. Maybe we want to fill up the 32 for some people because they're going to be in the 37. We
Exactly.
still want to take that 5% savings. And that's again, I'm talking when I say 37 and 32, I'm obviously comparing marginal rates. Note, we would obviously consider the effective.
We would.
It's just a lot
We'd
harder
factor
to
in all this.
it's a lot harder to quantify that, like without looking
So
at.
that becomes
Nobody's able to
very
follow.
individualized to
Exactly.
clients
You have to use software to analyze that. That's not something
without a
you're going to
doubt.
do on the back of a napkin.
Without a doubt.
Um, anyway, that's how we look at it, right? We're trying to minimize effective tax rates over time.
Correct.
Fair?
Correct. I think that's exactly right. And so then we talked about that in order to just kind of speak briefly about the Roth conversion ladders and
Okay.
just how that can be used to help kind of flatten that income that's realized and the taxes as well.
Right.
Mhm. So, any additional thoughts on Roth conversion ladders?
We are trying to, we would convert with the ladders. It could be at a different amount every year, but we're
Yeah,
trying to convert to the same effective tax rate every year.
exactly.
Maybe we figured out that your lifetime effective tax rate is 20%. Note, that is not a tax, that is not a marginal tax bracket, it's the tax rate. Okay. We're
It's your
so
big picture,
yeah, you
all the
might be in the
things.
24% with some IRMA considerations, and
Mhm.
that's kicking you up to the 20% effective rate.
Right.
Okay. So maybe we see your 20% effective rate and we look at this year and you're at 18. So we want to look at a Roth conversion that when it's looked at in its totality,
Yep.
bumps you up to
To
20,
20.
right?
Exactly.
Reasonable?
Exactly. Exactly. I think that's exactly right. And
Because one of the ways to quantify this, we talked about it a little bit before, right? When we talked about the $100,000, 32 versus 22, what you're saving is the amount that you've converted,
yep.
right? Or the amount of income you've pulled forward and then times the difference in rates. So in our example, when we said
Mhm.
$100,000 and then 32% versus 22% means 32,000 versus 22,000,
Mhm.
the difference is 10,000. What that is the difference between 32 and 22, 10% times the $100,000. Right? So the more income
Correct.
we can pull forward at a lower effective tax rate,
Mhm.
the savings is equal to the difference in the effective tax rate, right?
Correct. And you could even make an argument that the savings is even more because you are also growing the money in a tax-free account versus a tax-deferred one or a taxable account, right? So
You've done the math on that.
I did.
So if we assume the exact same investment returns, the same time horizon, everything else, everything's apples to apples, same taxes, same tax brackets, same tax rates, everything
Correct.
else, then it's 1 to 1. If I
Correct.
have $100,000 and I pay the tax today and put it in a Roth, and then I have $100,000 I don't pay the tax today, I put it in a tax deferred, I'm going to come out in a wash in 20 years,
Correct.
right? So we're talking about tax rate arbitrage here. We're talking
Mhm.
about the difference in brackets. We're talking about the difference in effective tax rates.
Correct. Well, and so then to really wrap up or put a bow on
Yeah.
the things that we've talked about, we discussed that the Roth conversions are an excellent tool to use to realize income in years where you're in a lower tax bracket. Okay.
Absolutely.
Um, when income is realized in a planned way, then you can decide when and how to pay the taxes rather than being forced by the IRS later through RMDs, taxation to heirs, or
Absolutely.
another
Yeah,
method.
let's be intentional about our income.
Correct. And then understanding both the marginal and effective tax rates can help you to plan your withdrawals from your retirement accounts. So the effective tax rate really helps you to see that big picture and your overall tax burden, your lifetime taxes that you're paying, while the marginal tax rate can help understand the tax impact of additional income, while also being mindful of things that are not dependent on tax brackets like IRMA.
Sure.
Um, so yeah, I think that kind of wraps up the pieces that we've talked about that are really specific to Roths and retirees or soon to be retiree.
Absolutely.
So yeah.
All right, guys. If you enjoyed today's episode, please like and review the show. And if you have any topics you'd like discussed or financial problems you would like solved, reach out to us at podcast@equilibriumfp.com or visit our website, equilibriumfp.com.
Till
Thanks.
next time.
Thanks, guys.